Now, I got to tell you, it was one of those sessions that rallies need from time to time to sort of, to test its resolve, if you will. But even though major indices closed off the low of the session, I will say there are still several areas of concern. Now, I've been pointing to market breadth for several reasons, including the fact that a broad rally is, of course, most desirable. It's the one that apparently has the most potential to continue. And, of course, there were decliners and down volume, and the breadth today was just horrific. Up volume was down. The milestones were really ugly. In the New York Stock Exchange, we had 49 new highs. 517 stocks hit new lows. On NASDAQ, almost as ugly. 35 new highs, 183 new lows. In the S&P 500, that's fractured as well. You know, 209 of those stocks for the year are down on the year. 58 of them are down more than 10%. 40, a whole 20% down 20% themselves. Now, although yields triggered the selling, the idea that a 3 handle on a 10-year, it's never been associated with a stock market top, yet it has given us some problems. Be that as it may, there are some glaring areas in the economy also that are problematic, and higher interest rates are not going to help, right? Stocks associated with housing and home building already taking it on the chin. That selling in those areas speeding up big time. The home construction ETF collapsing. So that sets us up for tomorrow. All eyes on this jobs report, wages, anecdotally connecting all the dots, and from all the other data out there, I think the median wages could see a 3% increase year over year. Now, that would be great news for Main Street, but what would it mean for Wall Street? I want to bring in now one of my favorites, Art Hogan, Chief Market Strategist for B. Riley, FBR, and the B. Riley Wealth Management. Art, welcome to the show.
Thank you very much. Thanks so much for having me.
What do you make of the last few weeks as we were going higher? The beneath the surface, though, the quality of the rally has been deteriorating. A lot of new lows, a lot of down volume, fewer and fewer winners. Does that worry you at all?
A little bit. I think that here's the 3 things that I think are happening that we don't talk about much. And one is, yes, the yield on the 10 years above 3%. But the last time that happened this year, the market freaked out and sold off, some 15%, and that happened in about a week. So I think the market's handling that better. I think the second thing that's happening is we're losing technology as leadership. We have for about 3 weeks. It started with some of the social media stocks thinking about how safe they keep our data and perhaps if we need new regulation and things of that nature. That was the beginning, but then semiconductors, either KLA, the semiconductor equipment maker, or a lot of the AMD that, is talking about demand in the fourth quarter. Those 2 groups in technology selling off, I think, has been the leadership for the last 2 years.
Sure.
So if you lose that, the market's got to pick it up somewhere else. And when you think about it, we're only, 1.5% off an all-time high? That means technology can sell and something picks up the pace. And here are the 3 things I think are happening quietly. The financials have been terrible, awful, the worst performing group in the S&P 500. When technology sells and the yield stays above 3%, actually, financials are going to start to get a bid. I think that's happening.
Will it be a big enough bid that they have coattails?
I think so, yeah. I think that if you can lose technology as leadership and still have a market at or near all-time highs and pick up leadership from healthcare, financials, and diversified industrials and consumer discretionary.
Real quick, tomorrow morning, jobs report that's north of 200,000 and wages are 2.93%. Does the market continue to freak out a little bit?
No, the market looked at the ADP number that was significantly north of expectations and was fine.
So we're rooting for a good number.
We're rooting for a good number.
All right, thank you very much. Appreciate it.
You bet.